Hey guys, Ken Boyd with the Accounting Accidentally website, where you'll find over 500 blog posts, and if you scroll down toward the middle of the page, you'll see links to over 400 of my YouTube videos. So I wanted to talk about a Quora post, question I answered that was, is it a good idea to invest 10% of your salary in the stock market every month? And while I'm a big fan of disciplined monthly investing, it may not be suitable to invest all of those dollars in the stock market, as I explained below. And I make the point that when people rush and don't pause to think and plan, bad things can happen. I was reminded of getting my hair cut with somebody who was rushing along and it appeared to be heavily caffeinated, and I wondered when I get my hair cut and look in the mirror, is this going to look normal or not? So rushing can be a bad idea. So let's avoid mistakes and plan carefully, starting with monthly investing. Monthly investing is great because you can compound your earnings, meaning that you earn interest on interest. And when you earn interest on interest, your earnings can be much higher. And I make the point here in the middle of the article of somebody investing $1,000 at 5% and taking the $50 in earnings and adding that to the thousands of dollars that they invest in the next year. And because they invest $1,050 rather than just $1,000, they earn more money, $250 more than they did in year one. That's a simple example of how compounding works, and the longer you compound, and when you compound at higher and higher rates of return, you can make a whole lot more money. So it's something worth thinking about. And the second thing is, now that we've talked about compounding, what about making an informed investment decision? So what's a reasonable amount of return on stocks, a rate of return annually? Well, the S&P 500, which is a basket of the 500 largest stocks, a common index that many people follow, has averaged 10 to 11% between 1926 and 2018, but there have been huge fluctuations both up and down. And the question is, with such huge fluctuations up to 30% up, 30% down, is that fluctuation you can live with? If your investments decline 20% in 1 year, could you live with that? If that's too much volatility for you, invest less of your money in stocks and consider instead corporate bonds or some other investment vehicle that's not so volatile. Beta is a great way to measure stock market volatility. It's a number that talks about how closely price changes in a mutual fund or a stock track with an index like the S&P 500 index. A beta of 1 means that your mutual fund, which is the best example for beta, moves at exactly the same price as the index. So if the stock index is up 8%, so is your fund. If it declines 5%, your fund does the same thing. So my conclusion here is, if you have the self-discipline to save and invest 10% of your salary each month, you can accumulate an investment portfolio for retirement. However, you need to consider your own risk tolerance, how much risk you're willing to take, and talk with a financial advisor. So that was my answer on the question about investing 10% in the stock market each month. Remember that on Accounting Accidentally, you can also find live courses, free downloads, and other information. Thanks very much for watching, and we'll see you next time.